Hello, everyone, and welcome to the Q&A. Basically, ask us anything for May 10th of 2023. For a second, I actually kind of forgot the date. All right, so we had CPI come out today as far as basics on like the macros and things like that. So we'll just kind of brush up and see what's kind of going on in that world. Let's see here. We will. All right, so just to give us kind of a general overview of what is going on here. Here in the background in blue, we have the CPI right now. And you can see that, let's see if I can get this right, kind of zoom in here, hold my mouth just right. We have a little drop in the CPI that pushed us down underneath 5%. I don't know if that's something to be necessarily getting excited about, but this CPI dropping is kind of a good thing on a sense that it typically means that the Fed isn't going to just keep on ratcheting up interest rates. Now, their quote unquote target is all the way down here at 2%. We haven't seen 2% inflation since, what was that? I think it was 2021. Yeah, March of 2021 was the last time we saw 2%. That was that massive acceleration of inflation up to the upside, which kind of pushed us into that bubble mentality, right? Or that bubble era. And since then, we went on a hiking spree, thinking that it was, quote unquote, transition or transitory. Guess what? It wasn't. And then now we crank up, and now it's starting to pull back. And now we're basically up here. Now, the whole deal is right now, at least the narrative that's going on in the news, is that the CPI coming down is actually going to be a positive thing. So it'll kind of stabilize. Now, historically, there is kind of a different story about this. So I'm going to kind of put this into like a 2008 terms. We're going to go all the way back here to 2008. So in 2008, you can see the Fed basically was hiking interest rates. They stopped, and then they pulled back interest rates as the market kind of collapsed, right? So something to note is that typically when the inflation numbers start to go down pretty dramatically, so too does stocks sometimes. And a lot of that comes to capital flows going out of stocks and going into bonds and things like that. This plays out a little bit differently in an inflationary recession. Typically in an inflationary recession, what ends up happening is as this inflation cools off and stabilizes, stocks typically rally. And we've actually basically been seeing that in blue chips. We haven't been seeing it so much in small caps, but that's also because we've still had a really slow growth. So basically growth sensitive assets such as stocks aren't going to really necessarily do anything. And so, yeah, that's kind of how we're at. Hi, Michelle. I see that you joined us today. Hello. Oh, you are, your mic is not there.
Oh, yeah. Hello.
Hello. Welcome.
Yes, thank you.
And what was that?
I said I'm getting caught up listening to.
Yeah, we're just basically kind of just brushing up on some of the macros and things like that. Nothing too crazy. And then just kind of general talking about where things are going, where things are at. So anyways, narratives are narratives. No matter what, as most of you guys know, I'm relatively bullish for the short term. And then I still think that there's probably a correction on the horizon at some point in time, but probably more closer to like the October timeframe or something like that. So we'll kind of see where things end up showing up. But for now, I'm relatively bullish, at least up here to let's call it. Here, I'll turn this into not percentages. I'll turn this into numbers. Yeah, 4,300 level area, something like that. That'd be reasonable for us to get up to. 4,330, 4,300. That's a good spot. So anyways, that's kind of where we're thinking about as far as what's going to kind of go on in the background, as long as these continue to kind of play out. Relative stabilization in the dollar from now on, and then yeah. So I think the thing that's always kind of interesting is we get questions sometimes about hedging, and it's actually it's an interesting thing that as I guess you'd call us, I guess Michelle, yeah, I guess you'd call us educators now, trading educators. Is that what we are? I still think of myself as a trader, but I mean, I guess we're helping out retail investors and traders. So I guess as a trading educator, we see kind of like the more emotional side of retail trading, right? So we get questions that revolve around like certain aspects, and it's not always like they're not irrational per se, but it's always like an emotional response typically. So like a lot of the times we talk about like hedging, right? And a lot of the times it's really interesting. I got probably the most amount of questions when I first started one of my services, the Sleep Well portfolio, over and like it was probably late 2020, around when the elections were. It was supposedly that like no matter who won, the market was going to crash, the world was ending. It was just so much fear was in there, and in fact, the Sleep Well portfolio was aggressively bullish on small caps actually at the time, and everyone was like, "Oh, you're stupid, right? All this, it's amazing what I got." But everyone was asking about hedging during that time period, and of course, during that time period, macroeconomically, everything was extremely bullish, right? And kind of similar to like what's happening now when in an inflationary recession, when the inflation is actually on the backside of its rate of change, and the economy, I wouldn't say the economy is accelerating, but at least as we see it right now, it's still looking pretty decent, right? So we're not necessarily going through as hard of a correction, depression, recession that we kind of did. The recession's kind of over at this point. Now we've got another one on the horizon for sure. So this is going to be a very short-lived bull market. It's not going to be like what we're used to, or what I think we've been used to over the last 15 years, where we just basically had a straight up market. Those times are way behind us. We're definitely looking more of like kind of what happened in the 70s, where we just got these gyrations for a while. But anyways, I digress. So let's talk about hedging, right? In general, hedging. Michelle, have you ever heard about hedging?
Yeah. I mean,
What types of hedges have you came across? Because I know you research like retail strategies quite a bit.
um, I don't know that I came across hedging a whole portfolio. They were sort of more individual trades. So I'm interested to hear
Okay.
what you have to say about it. I
Yeah,
don't
I
know much.
mean, hedging it really does depend on why we're hedging, right? And I might not necessarily have an answer that someone wants to hear. I think that's probably what I get the most when someone asks me about hedging, and it's because the way that I hedge, takes effort. It's not like a quick like, oh well, I'll just put on this structure, right? That's kind of not how I do things. But we can talk about structures and things like that as well. So getting some questions about hedging and things like that. Let's just look in general. What is a hedge, right? So let's define a hedge. What a hedge is it takes care of, well, just a typical hedge is that when an asset or a trade or something takes a loss, right? The hedge should gain, right? So in a perfect world, as something loses, something would gain, and they would net not lose any money, and you'd be hedged off. But of course, if you hedge off all of your risk, a lot of the time, what ends up happening is you make no return, also, right? Because as this one's winning, this one's losing. As this one's winning, this one's losing, and so they just gyrate, and you just spend a bunch of money in commissions. So, or volatility eats you alive, or something like that, right? More mistakes. So that's like your typical hedging. Some of the first like hedge funds were statistical arbitrage. So basically, when stat arbs came out, it was during the time that it was Edward Thorpe. So by the way, if you don't know who Edward Thorpe is, go take a look at him. He's amazing. Anyways, basically what it came down to is the stocks that lost the most amount of money that day, the next day typically didn't lose as much or would even somewhat recover, and then those that gained the most that day would normally kind of pull back a little bit, right? And so what you could do is you could sell the ones that rallied really strong, and you could buy the ones that kind of dive bombed, and every day you would just stat arb it. Inevitably, that was the first hedge fund, right? Because you were hedged. Inevitably, history lesson wise, I think J.P. Morgan got into that. I think it was J.P. Morgan started to do that with some of their funds. Of course, those funds are so massive that they basically eroded the edge, and now stat arb is basically dead. But it was cool while it lasted. So the point is hedging and why are we doing it? So I think what most people talk about hedging nowadays is some sort of like a black swan. We actually recently had what I would call probably like a modern day black swan, and that would be COVID, right? Basically, the economy comes to a complete halt. We hit limits, we hit circuit breakers, we hit everything, right? Everything you could imagine basically got hit in COVID. We have circuit breakers now no matter what. So on a 1-day basis, we basically can't go down more than 10% in the S&P. Granted, at this time we had, I want to say, like Amazon got chopped in half. Tesla was down like 60%. I mean, everything was just getting murdered in this time period. REITs were dying. I mean, everything was just getting obliterated in COVID as like the massive risk off was kind of happening. So that's kind of what I would consider our modern day black swan. And of course, you saw what the central bank did come in, things like that. So in a sense, the central bank and the U.S. government, at least in the U.S. here, just kind of won't let things go beyond a certain level. And it looks like, somewhere around that 33%, kind of time period within about 3 weeks is probably about kind of like the pace at which we could assume. Sometimes people talk about, let me just hide these guys. Sometimes people talk about all the way in 1987. And 1987, we'll go to weekly, so it won't take me as long to get back there. There it is. There's 1987. We'll zoom into this. So 1987, and we'll turn this back to candles here. For candles. So you can see here, this is on a 1 week basis, right? So these are some massive bars, right? And then if we even turn this on to a 1 day basis, let's see if I was in the right zone. Oh no, it made me go all the way back. Hold on. This is going to take me a second. Almost there. All right. If we look on the 1 day bars, this is basically what kind of everyone kind of remembers as like black swans, right? And this was a 1 day move of like 25% or 22% or something like that. It was a very massive 1 day move. And you can see here basically what happened. The market started to roll over, the risk on, and then it eventually blew up. And that was, back with the portfolio insurance era and stuff like that. Now, bubbles always have a certain signature. Keep that in mind. I've talked to this about in the Adapt Advanced class. So you guys are pretty familiar, and you guys can basically see that pattern exists right now. If you're in the Adapt Advanced class, you're kind of like, oh yeah, I see it. Like it's clear as day. That's a straight up bubble. But if you're not, you'll learn that at some point in time, whether you join us or not. Now, the point that I'm making here, though, is, are you trying to hedge for this, or are you trying to hedge for like just a typical loss on your trade? The way that I deal with my hedging, first of all, on a trade by trade basis, is I make it part of the trade, right? I'm okay taking losses in my trades. and I allocate appropriately if I have some sort of blowout trade, right? So even on my options trades and things like that, I don't have so much of my portfolio in them that if they were to have some sort of catastrophic event, that I'm basically belly up for the rest of my life, right? Like, that's just not how I function. And I think that that's probably the best hedge you can have. Now, the other hedging that I use is I diversify. Now, everyone's like, oh my God, diversify. Never hear the end of it. Of course, you use different trades. Of course, you spread it out. But hear me out, though, because I have a little bit of a different take on diversifying. I believe that when you're trading any specific trade, the way that trade takes a loss. So like, let's say that you've got here, we'll just take a bullish vertical. I'll share this screen. Let's just go to, we're just gonna go to COVID, and I'll pull you guys up over here in just a second. I know you guys can't see my screen. Okay. So if we zoom in, let's put a different type of trade on here. All right. So we've got, if we look at our price chart, right, this is near the beginning of the end. Of course, we don't know this right now, but this is February 4th, 2020. COVID's going to happen right around the corner here. But let's just kind of, I think in March or something like that. But let's just put like a long-term trade out here. Huge days, 1.8 percent to the upside. Really hard to say the world's ending at this moment, but we knew that things were getting pretty hairy, by the way. It's not like these black swans come out of the blue, by the way. You kind of always know that they're going on. Even COVID, like you knew things were going on. You knew that they were going to be a problem, right? Not necessarily because of the news. Don't ever pay attention to the news. But it's where we are in the macro cycle, right? I talk about macros all the time. It's really important to know where you are in macros, because in specific macro environments, it's not that it creates the crash. It's just that small catalysts in those very fragile times can create risk-off waterfalls. So that's kind of how you know things are happening. 1987 was the same way, right? It's still in certain macroeconomic environments, right? So let's say we get out here at, let's do 52 days or so, like that. Sounds fun. Okay, so let's just say that we've got some sort of, I'm going to use smaller contracts this time. All right, so we got 20 contracts on here. We got about $130,000, right? So here, I'll use smaller. I know I'm gonna get a comment on that. Here, boom. Okay, there, $6,000 trade. So we got a $6,000 trade that's relatively bullish. We got a little bit of time decaying here. I mean, it's crazy bullish, right? I mean, let's just say it's crazy bullish. But let's just say this has been working forever, right? And this is like the trade to do, and it's like, yay. And we've had this massive bull market for so long that you just buy the dips, right? Like that's just what you do. And so this is your thing. So of course, anyone that's a buy the dipper right now in this situation is freaking out, right? And so we're going to throw this in test. And the reason why they're freaking out is because, first of all, it's scary and you've got all of your risk down here. And most likely you're probably using too much of your account in this trade setup. But why are you using too much of the account in this trade setup? Well, it's because you're aggressively long. So remember what I was talking about, stat arbitrage, where you were basically buying stock and you were shorting stock, and equal weighted, you didn't have any risk, right? There wasn't any directional risk in the market. Well, right now we have a lot of directional risk, right? So what could help us in this situation? Well, what if we had a whole nother trading system that wasn't built around bullish trades, right? What if it was built around, um, what if it was built around, time decay below the market or bearish moves or something like that? Maybe it's not always on because it's pretty hard to be bearish against the market all the time and still actually make money. You either got to compensate it with, using time premium and getting up underneath it when it doesn't work out for you, or you've got to be really quick on the trigger on small pullbacks, things like that, right? You got to use some sort of other trigger, but I'm digress. So let's just say that we have another trade back here. So let's say that we have, and I'm just going to slap something on here and make sure that I've got this right here, and I don't. Okay, and we're going to do a separate. Okay, so let's just imagine for just a second here that we have two trades. All right, so these are our two trades, right? Now together, they don't necessarily cancel out, right? But if we combine them together, you can start seeing that we do reduce the delta on this, right? And now what I do is I would definitely make sure that each one of these are allocated appropriately to their volatility and their risk rewards, and make sure that they're balanced between the two, at least in volatility, so that they don't, one's not more powerful than the other versus how much they return. But let's say that we want to, at least in this situation, even out their deltas. Right? So you can start seeing here, funny enough, when you start taking a vertical strategy and then you start sticking on a butterfly behind it, you start to get like a broken wing butterfly, right? A more like delta neutral trade. And these are two trades that when you slap them together, make a pretty nice little structure here. And these were really hot for a long time, broken wing butterfly type style trades. They will be hot again, I'm sure, later this year and probably over the last, I don't know, probably 4 months. They've probably been working really great. So you're probably going to hear a lot of hoopla about these and how amazing they are now. You didn't hear anything about them early last year, that's for sure, though. So as far as where we're going with this, or like late 2021, that was a big one. Anyways, now that we're in this situation, this is where two trades can offset each other and they can hedge themselves. Now, to a certain extent, right? Because they still got risk to the downside. So then that starts coming back to, okay, well, if you're trying to protect yourself from just like a super blowout to the downside, that's a totally different animal. Now, if you're part of the Adapt Advance, this is, and I'm speaking directly to some of you guys that are in Adapt Advance. If you've got a trade structure on that you're pretty bullish on, and maybe you're not very confident in kind of everything that's rolling, and maybe the metric is somewhat conflicting itself or something like that, and you want to put some sort of hedging to the downside, the structures in play are what you want to focus on. So, for instance, if out of the money puts are in play, just come down here and just buy, just buy some of these guys and flatten out whatever delta or flatten out whatever risk that you're really trying to hedge off, but put that into your trade system, right? Like, okay, I'm still looking for certain profits. I know that that's going to drag a certain amount. So that way it's within the trade plan, but you're kind of protected to like some sort of flash down move, because that's maybe what the fear is, right? So it's always better to kind of take care of this. Of course, the other situation, don't trade as large, right? You can just reduce your trade size. That's really hard for some people to do, though, and I understand that. You're like, well, yeah, but I won't make the return. Yeah, but sometimes the hedging costs us just as much as as just reducing the allocation. So keep in mind that that's kind of something to play in there. If debit spreads are in play, out of the money debit spreads, don't do puts down here. Do debit spreads, right? Debit spreads are amazing when they're in play down here, and they can take on a really nice big hedge to the downside. When they come down here and pop out, they have a nice little inflation. It's pretty nice. And then a lot of the times what can happen when you get like a really big push down and kind of a crash happens, you can end up buying back or you can sell back your puts and just kind of hold on to your your cells down here and just make a boatload of money to the other side when it rebounds. You can kind of play with it, have fun. But anyways, so that's one way to kind of go about things. So as far as hedging is concerned, use a structure that's in play if you're in Adapt Advanced. If you're not in Adapt Advanced, then what I highly suggest, because it's not going to be part of your trade, is find a strategy, whether it's a retail strategy, whether it's something you created yourself. It just, whether it's something, it's either needs to be uncorrelated or inversely correlated, and allocate appropriately to that. So if like for instance, I've shown this chart before, but let me just I'll pull it up in just a second. Let me get to it. Okay. Stop sharing. So this is something that I've talked about before in certain classes and stuff like that. But so basically, what you have is you've got the red strategy, which is actually our Adapt Daily strategy, and then you have the Adapt Intraday Calendar strategy right here that are in blue. Right, both are very strong strategies in their own right. Keep in mind that what I did is I reduced the allocation to the calendars to make them relatively as strong as the Adapt Daily. And what this does, but then what I did is I blended them together. So once I allocate them appropriately, right, you can see here it makes these pullbacks and these losses significantly less because of how uncorrelated these two trades are. You can actually see here in general, look at this one pulling back, and look at this one pulls back at a different time when this one's actually rallying. They make money in such uniquely different ways that they don't drag each other down. Here's a pullback in the calendars. Here's a rally in the dailies, right? So that's all kind of a cool situation. You can even see that in this pullback right here. The Adapt Dailies pulling back, and the Adapt calendar and the calendars are lifting up, right? And so you can see here when we blend the two, when we get to yellow here, it's basically just one smooth line in the middle. That's one way to hedge. Keep in mind that hedging, or I shouldn't say hedging, but like diversifying, if it's not diversified well. So this is one thing that people think of is like stocks and bonds. That's being diversified. No, that's totally not. Stocks and bonds can lose at the same time. That's what happened in 2022, and they get murdered, right? There's certain times and certain macro time periods that's going to be a problem. That's why we saw it coming. If you're trying to put two trading strategies together, make sure that they fundamentally can't lose together. Like literally, for one to win, the other one is losing, right? But then have them both to where they can actually win at the same time, right? So like let's say you've got a bearish position that is bearish and theta based, right? So it can make money if the market sits still, and it can make money if the market goes down. Perfect. That's a cool little trade. Then let's say you've got another structure or another trade that makes money when the market sits still and when the market rallies. Great. Those two trades overlap if the market sits still. So that means they can both make money when the market sits still, right? But if the market blows one trade out, either the bearish trade or the bullish trade, then then what happens is one hedges the other's loss, and that way you can actually trade with larger size, right? And eventually that's what we ended up doing, and I can show you that. So like that's when you start to take that lower allocation, like in yellow, and then you kind of amplify it, right? So that's how I use hedging, and that's how I hedge. So you either make it part of your trade plan and use a structure that's available if you're doing something like the Adapt Advance. If you're using the intraday calendars that we have, then running the Adapt dailies with them, they are a fantastic hedge with each other. If you're not running any of those systems and you're running your own thing, then find a strategy that complements it but can win at the same time sometimes as the other one. Blend them together and normalize their volatility. Easiest way to normalize their volatility, by the way, I'm just talking simple calculations, nothing crazy. Just look at their max losses, right? If one has a max loss of 50% and one has a max loss of 10, right? Then you know that the one with 10 is as a more docile trade, right? So that means that the one with 50 is going to get, roughly speaking, 1/5 of the capital as the 10% max loss. That's just a nice simple way. But look at the max loss, not like a max loss like, oh, this is what I'm maximum allowed to lose the trade at, like a max loss trigger. No, like look at the max loss of like when it gets blown out, like what does it lose when it gets blown out? That's the big deal, right? Because the blowout is what you're trying to hedge against. And that's the volatility that you need to compensate for. So that's the way. Michelle, what do you think about all that? Because I probably missed something in there.
So you would trade smaller, and then secondly, you would make sure that whatever you're trading is truly diversified, not just stocks and bonds.
Right. Yeah. I mean, I know like a sleep well and awake; those are both long only allocations. But sometimes we have 100% in one asset, and people are like, "Oh my God, that's not diversified." And it's like, yeah, but what ends up happening is, we're okay with the amount of volatility that's in a single asset. So we're not trying to reduce daily volatility. That's the important thing. I think some people get caught up with the difference between daily volatility and drawdown volatility or drawdown risk. And what ends up happening is if you focus on reducing daily volatility, you can reduce daily volatility really well by just adding a boatload of uncorrelated streams with each other. But you don't necessarily reduce the drawdown risk. And that's because a bunch of assets that lose the same way macroeconomically all go down together, right? When something happens. So like if I've got emerging market stocks, I've got stocks in Europe, I've got stocks in the US, I've got small cap stocks, I've got large cap stocks, I've got bank stocks, I've got material stocks, I've got mid cap stocks. So I get all these stocks together, and then like let's say I get some bonds together. I've got short term bonds, I got long term bonds, I got medium term bonds. Say I've got bond volatility bond volatility ETFs, right? You start putting all these things together, and you do have significantly reduced volatility on a daily basis. But all of those stocks that you have together are all going to get blown out at the same time, right? If something macroeconomically happens, a risk off event, a COVID, something like that, they're all just going to go down together, right? What's going to offset that is what is creating the macroeconomic push in the very beginning. Well, if you're in a lower inflationary environment, then bonds are a great hedge, right? If you're in a high inflationary environment and that happens, get out of bonds because they are not going to save you. They are going to be the worst thing ever that you can have. And you want to be something in more like in gold, or you want to be in commodities, or you want to be in, you want to be short on shorter dated bonds or something like that, right? Something to offset your risk fundamentally based on what's going on in the macros. So that's the way you properly hedge on like a macro basis for assets. And you guys a lot of you guys saw that with the sleep well and how we dealt with the recession, and we ended up making new highs mid year last year, and we're right back marching up there in awake, and sleep well's climbing as well. So Anyways, yeah, reduce exposure. Make sure you're fundamentally uncorrelated. Those would be two different ways. Put on a structure that's in play if you're doing something like an adapt advanced trade, and for your hedging to which side you're risking. Sometimes you're risking to the upside, right? You're worried about a blowout to the upside. If you're worried about a blowout to the upside, just make sure you're using a structure up there that's not costing you too much, and you can still make your targets, your win targets on those. And then when you diversify, make sure your volatility is normalized, so not one takes on too much weight. In a perfect world, you'd have two opposing trades that both have positive expectancy, and you rebalance between them on a per trade basis. That would be the perfect world, and you'd have your perfect hedge, and you really wouldn't need to worry about anything.
I think that's perfect. I think it's a different approach than people are used to hearing. But those structures of or just buying puts or something, day in and day out gets so expensive that it just
Yep.
defeats the purpose of trading to begin with.
Yeah.
So,
You're just gonna drain. It's just gonna be throwing away money, right? There's a reason why selling puts beneath the market makes so much money over time, and there's a couple funds that that I've personally known that blew up doing it, but for a long time we're making a lot of money. Just selling puts below the market until that one event happens, right? And that one event like Volmageddon in 2018, and they end up blowing up, and that's when hedging finally pays off. But at the same time, did it pay off enough, right? Well, it paid off, for those guys that were getting blown up, but did you buy enough puts that time to offset it? Was it good enough? There were a couple strategies back in the day that were basically like hedging strategies. They're pretty cool, and they're probably still around. But basically, it's like a rolling put credit spread that inevitably sells off the short puts, and then you're basically left with just a long put, and you kind of keep rolling it week after week after week after week after week, and it's kind of this campaign style. The one challenge with that is that you always do have some sort of a dip back there, that if the market goes down at a specific pace, it won't pay off. It's a good strategy if the market is going up and the market doesn't necessarily go down. But there are some specific circumstances in which you can take losses in that trade structure, and you definitely have to have like something like portfolio margin to do it, because you are running, you've got like a dip back there, so the margin that it would cost you is a little bit high. But anyways, it's a cool little system, and the big thing that I noticed with a lot of people that use hedging structures is when to take them off, right? If they're there to hedge your primary trade, well, if your primary trade takes a loss, then take your hedge off, right? I've definitely heard of some people that lost their trade and then left their hedge on to try to make money on the hedge now, but that's not what the hedge was meant to do. So what I'm talking about is like, what I'm talking about is like when you have, so say you had like something, it was like a campaign. Like I said, you have a campaign here, and so you're gonna have a couple of these back here. So let's say there's like three, 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 and then back here, let's just say we had some. So three. Let's say we have one more. Okay, so let's just say like this is our hedge right here, right? And we've been basically making this for a while or something like that. And I mean, this might be a little too powerful right now. I don't think that we're supposed to have more than one on. So here we'll just we'll take this guy off. No, he's not enough. Yeah. Anyways, I can't really like synthetically make it too much because it kind of decays over time. But in essence, if this market kind of stays still or climbs up, what eventually you'll do is you'll make money on these shorts, you'll sell them off, and then you'll just basically have these longs back here. And every time you're kind of closing them for just like a very minor credit, just a very, very, very minor credit. And basically the only way that this trading system loses money is if the market just kind of slowly ekes back here and just slowly degrades and never rallies, right? You never get a V bottom, you never get a rally or something like that. It's basically if this market just kind of chops down here and eventually you just get eroded, right? So the hedge doesn't actually pick you up, right? The trading system just dies. But if the market just bricks down here and you're trying to protect against this thing will pop. It'll just explode, and it's amazing. And it makes a lot of money. Well, if this guy was meant to protect a structure that was, say, bullish, and the market comes down and you get this pop back here, right? The Vega pops back here. And of course, this isn't exactly how it would play out, but you get some sort of Vega pop back here, you offset it, and that offsets your loss in the other trade. Then you're done, right? Close this guy off, shut down your primary trade. I actually had this in Volmageddon. I had a structure that was very similar to this because I was hedging going into Volmageddon because it was a bubble. And doing that, it was like midnight, or it wasn't midnight. I think it was, anyways, I saw the futures were down and my structure was in the futures. And so, and like I said, it was very much like this. I was doing a campaign rolling style, lots of long structures. I had ratio spreads, right? So the market was down really aggressive overnight. I closed that all out. But what ended up happening was because that offset a total loss in my primary trade, right? So basically, when I woke up in the morning, I wasn't worried about my primary trade because I had already covered the entirety of that trade and the profits that I made from my hedge. Well, then when I woke up in the morning, the market had rallied really aggressively and my trade was actually still on and we were good, right? And so I actually just let my trade roll that day and inevitably ended up max winning as well. And so that's kind of one of those structures that you can kind of play with. So something like that, those are two different, that's a type of hedging strategy that you can run, but it has its risks too, because it's not like it's not like it wins forever and it's always a winner. There are ways that this can lose, and if you pair this with a broken wing butterfly strategy, you have a lot of risk right here behind the market. If this market slowly or like kind of like chops down, it degrades a broken wing butterfly, and then you fall into this sea of doom back here and everything loses money and you're depending on your portfolio margin to hold up or something like that. And you can end up taking way more losses than you ever had. And those are the stories that I remember most from dealing with retail traders that were dependent on a hedging strategy like this to make money. And that's when it's, you know, when I worked with them to develop a multiple trading strategy approach to where everything has positive expectancy and you just rebalance between all of them. And now you just don't even have to worry about hedging. It's not even like a concept that you even have to think about because you've already got strategies in place to take care of different things that the market does, right? If the market is in crash mode, this strategy will do phenomenal. If the market's in stalling mode, this strategy will do fine as well, and things like that. And they're all overlapping each other and you just make money in every way you can. All right. That was my spiel.
Mm-hmm. Yep, sounds good. I think that
all right, guys.
answers the question in a lot of different ways.
Yeah, and reach out to us in the forum again. That was a question that was sent to us. So that's why we dove into that today, as far as macros goes and things like that. So anyways, send us a question. You can send us at info@etradingedge.com. You can of course always ask us here directly in the comments if you catch us live. And then beyond that, we'll see you guys next week, Wednesday at 3:30. And if you guys are part of our services, then we'll see you before then.
Yep. Bye, guys.